When a crisis hits, governments move fast. Wars, financial crashes, pandemics, each time, the same solution appears almost instantly: print money. It's presented as necessary, responsible, even heroic. Leaders tell us there is no alternative. The economy must be stabilized. Jobs must be protected. Markets must be saved. But beneath the urgency lies a deeper mystery. Printing money is designed to protect society as a whole. Why does it so often leave the average person struggling with higher prices, shrinking purchasing power, and heavier debt burdens, while a smaller group seems to emerge wealthier than before? The answer isn't obvious at first. In fact, the system is structured so that the consequences appear long after the applause fades. To understand this pattern, we have to go back to when money had limits. For centuries, currency was tied to scarce resources like gold or silver. Governments couldn't simply create more at will. They had to tax, borrow, or acquire it. That constraint acted as a brake on excessive expansion. But the 20th century changed everything. 2 world wars forced governments to finance enormous spending quickly. Central banks became partners in creating new money to purchase government debt. The process seemed effective in the short term. Later, when the link between major currencies and gold was severed in the early 1970s, money became backed not by physical scarcity, but by confidence and policy decisions. From that point forward, printing money during emergencies stopped being extraordinary. It became standard operating procedure. Every episode begins with a justification rooted in urgency. There is always a pressing threat: collapse, unemployment, instability. Speed becomes more important than scrutiny. Central banks expand their balance sheets, governments authorize stimulus packages, and trillions are created electronically. The logic appears simple: inject liquidity, encourage spending, prevent collapse. And initially, it seems to work. Markets stabilize, fear subsides. Headlines announce recovery. But what's rarely discussed is how that money enters the economy. Newly created money does not flow evenly to every citizen at the same moment. It enters through specific channels: large financial institutions, government contractors, asset-heavy corporations, and markets for bonds and equities. These entities receive and deploy the funds first, before the broader public feels any change. They purchase assets while prices are still relatively low. Stocks rise. Real estate climbs. Investment portfolios expand. By the time stimulus checks, wage adjustments, or broader relief measures reach ordinary households, prices have already begun to adjust upward. The increase may be subtle at first, almost invisible. But over time, it compounds. This is where the delayed consequences begin to surface. Inflation rarely appears immediately. That delay is politically convenient. In the early stages, the economy feels rescued. Asset markets surge, and those who own financial instruments see their wealth expand dramatically. Meanwhile, wages tend to adjust more slowly than asset prices. Savings held in cash quietly lose purchasing power. Housing becomes more expensive. Food and energy costs creep upward. The average person doesn't see money multiplying in their bank account. They see prices rising at the checkout counter. Eventually, inflation becomes too visible to ignore. At that point, central banks attempt to reverse course by raising interest rates or tightening credit. But tightening after expansion creates its own consequences. Borrowing becomes more expensive. Businesses that relied on cheap credit struggle. Governments face higher interest payments on the debt accumulated during the emergency, and households carrying variable rate loans feel immediate pressure. The same system that was flooded with liquidity becomes restrictive. The cycle turns. Throughout this process, a consistent pattern emerges. Those closest to the initial creation of money benefit from early access. They acquire appreciating assets before prices reflect the new supply of currency. By the time inflation spreads broadly, much of the wealth effect has already been captured. Meanwhile, those who rely primarily on wages or fixed income experience the lagged costs. Their earnings rarely rise as quickly as asset valuations. Over time, the gap widens. Attempts to fix the imbalance tend to focus on surface adjustments. Policymakers introduce regulations, tweak interest rates, or redesign stimulus structures. but the underlying mechanism remains intact. Money creation continues to enter through concentrated channels. Each new crisis reinforces the normalization of emergency printing, and with every repetition, the scale grows larger. Global debt expands, central bank balance sheets grow, set markets detach further from everyday income levels. Modern history shows this clearly. After major financial disruptions, unprecedented monetary expansion led to soaring asset prices and widening inequality. The official narrative centers on rescue and stabilization, yet the long-term outcome consistently reshapes wealth distribution. The pattern is almost formulaic. Crisis strikes, money is created, asset prices surge. Inflation spreads, tightening follows, and the public absorbs the adjustment. Three lessons emerge from this pattern. First, money printing does not create wealth from nothing. It redistributes purchasing power across time and position within the system. Second, inflation is not merely an accident of policy, it is often the delayed reflection of earlier expansion. Third, each emergency strengthens the normalization of extraordinary measures, making future expansions larger and faster. The deeper warning is subtle. Over time, repeated interventions reshape expectations. Markets begin to anticipate rescue. Governments rely on expansion as a default response. Citizens adapt to gradual erosion in purchasing power without connecting it to earlier policy decisions. The winners are rarely announced. The costs are rarely immediate, but the pattern persists. The next time an emergency justifies massive monetary expansion, the real question may not be whether action is necessary, but how and through whom that action will flow. In financial systems, timing determines advantage. And in every cycle of money creation, those closest to the source tend to benefit first while everyone else discovers the consequences later.